everyone. I'm Dr. T. Usharani, Assistant Professor, Department of Commerce, Kumaraguru College of Liberal Arts and Science. Today, let's begin by exploring why understanding sources of finance is crucial for business success, especially in India's rapidly changing economy. In this unit, we are going to discuss about sources of finance. Financing decisions are key to any business success. They influence day-to-day operations, expansion, and long-term sustainability. With India's economy growing and evolving, businesses need to be strategic in choosing the right sources of finance to stay competitive and resilient. For instance, small and medium enterprises in India often struggle to access funds. By choosing the right mix of financing, whether it's government grant, loans, or equity, businesses can overcome these challenges and scale. Big names like Paytm, Swiggy, and Zomato have used venture capital, private equity, and public offerings to fuel their growth. These choices are strategic, balancing ambition with financial health. Now, let's explore the common sources and forms of finance that business can consider. Internal and external sources such as equity, shares, preference shares, bonds, debentures, and fixed deposits, lease financing. Understanding these sources is crucial for anyone involved in finance, whether you are a student, a financial analyst, or a business owner. The right choice of financing can significantly impact a company's operation and its long-term success. Let's begin. Let's start by looking at sources of finance that come from within the company itself, known as internal financing. Internal sources of finance include retained earnings or reinvested profit. These are resources that a company generates and reinvests back into its business. For instance, Tata Steel often reinvests part of its profits to fund technological upgrades. This financing provides control and flexibility but can limit growth if retained earnings are insufficient. External sources of financing. Where external sources of financing, business looks beyond its own resources to fuel growth. External sources include debt and equity financing. In India, companies like Infosys and Wipro have raised funds through equity shares listed on the stock market. External sources enable rapid growth but come with commitments such as interest payments or shareholder expectations. This makes it essential to weigh operations based on company needs. Government grants. Let us discuss on government grants that offer businesses a way to receive financial assistance with specific goals in mind. In India, the government provides grants to support industries, especially for small and medium enterprises. For example, MSMEs can benefit from the Credit Linked Capital Subsidy Scheme (CLCSS) to upgrade technology. Grants are ideal for projects with social or economic impact like renewable energy, startups, or rural development projects. Let's look at crowdfunding, an increasingly popular source of finance in India's startup ecosystem. Crowdfunding is an emerging financing model. Indian platforms like Keto and Milap allow businesses and individuals to raise funds directly from the public. For startups, it's an effective way to get initial capital and customer support. For example, a young entrepreneur can crowdfund an eco-friendly product idea on these platforms and receive support from conscious customers. Moving on, let's dive into equity shares, a popular form of financing that gives investors ownership in the business. Equity shares represents ownership in a company and shareholders have voting rights. Companies like Reliance Industries issue equity shares to fund expansion. Shareholders benefit from potential appreciation in stock value. However, returns are not guaranteed as equity investments carry risk based on market performance. Now that we understood what equity shares are, let's weigh their advantages and disadvantages. The main advantage of equity shares is the potential for high returns and long term appreciation. However, investors take on higher risk as stock values fluctuate. In India, IT companies like TCS and HCL have provided substantial returns to equity shareholders, but market volatility can also lead to significant losses. Next, we'll explore preference shares, which are a bit different from equity shares and offer more stability to investors. Preference shares provide a fixed dividend and priority in liquidation over equity shareholders. Indian banks like SBI issue preference shares, offering a steady income with less risk than equity shares. But investors in preference shares often miss out on the growth potential that equity shares can offer. Let's now look at why some investors prefer preference shares over equity and what the trade offs might be. Preference shares are safer and ensure regular dividends, beneficial for risk averse investors. However, they lack the high growth potential of equity shares. In India, these are often used by conservative investors looking for predictable returns, such as senior citizens investing in stable companies. Now, let's look into bonds and debenture, the popular form of debt financing. Bonds and debentures are debt instruments with a fixed repayment schedule. The Indian government issues bonds to fund infrastructure, while corporations like HDFC issue debentures to finance operations. Bonds are lower risk compared to shares, especially those with strong credit ratings, making them attractive to conservative investors. Here, we'll go over the benefits and downsides of investing in bonds and debentures. The key advantage is predictable returns as bonds pay regular interest. However, bonds generally have lower returns than equities and may lag behind inflation over time. For instance, a conservative investor might choose Indian government bonds for steady income, though this comes with moderate growth potential. Let's turn to fixed deposit, a familiar and secure investment option, especially popular in India. Fixed deposits are popular in India, especially among risk averse investors. Banks offer FDs with fixed interest rates over a set period, guaranteeing returns. For example, senior citizens in India commonly invest in FDs due to their security. Although safe, they offer limited liquidity as funds are locked in. Now, we'll discuss why fixed deposits are attractive to many investors and the potential drawbacks they carry. FDs are secure and provide guaranteed returns, making them ideal for short term savings. However, interest rates may be lower than other investment options, limiting long term growth. Despite these drawbacks, FDs remain a popular choice for Indian families looking for stable and secure savings. Let's talk about lease financing, which allows businesses to use assets without having to buy them outright. Lease financing allows businesses to use an asset without ownership. For example, an Indian logistic company might lease vehicles instead of buying them, allowing operational flexibility. Leasing reduces initial cost and offers tax benefits, making it attractive for businesses with high capital needs. We look at the different types of leases and how businesses in India use them for various purposes. There are two main types of leases, operating lease and financial lease. An operating lease is a short-term and less expensive, often used for equipment. A financial lease, meanwhile, is long-term and more akin to ownership. Leasing is common in sectors like aviation, where Air India leases aircraft to reduce upfront cost. Here, we'll weigh the benefits and limitations of lease financing as a tool for business growth. Leasing offers several benefits, including reduced capital expenditure and tax advantages. However, total cost may be higher over the lease period. Businesses in India often weigh leasing as a flexible alternative to outright purchasing, especially for assets with short lifespan or rapid depreciation. When it comes to finance, managing risk and return is a balancing act. Let's explore the concept further. When selecting finance sources, businesses must consider risk and return. Higher risk options like equity shares offer higher return, while safer options like FDs and bonds provide stable but lower returns. For example, young Indian entrepreneurs might prefer high growth investments while retirees might prioritize security. Let's talk about the cost of capital, which is a crucial factor for businesses when choosing finance sources. The cost of capital varies based on financing type. Debt instruments come with interest rates, while equity involves potential dilution of ownership. Companies like Infosys carefully balance debt and equity to optimize cost and manage shareholder expectations, ensuring sustainable growth without excessive debt. Good financial management is the foundation of any successful business. Let's see why. Effective financial management helps companies allocate resources efficiently. In India, businesses like Reliance have mastered this by diversifying investments and controlling debt. Strong financial management is crucial for sustainable growth, especially in volatile markets where economic shifts can impact funding. As we conclude, let's review some key financing options that companies frequently use, each with its own strengths and limitations. Equity shares allow companies to raise capital by selling ownership stakes to investors. This means shareholders benefit if the business grows with potential for high returns through dividends and share price appreciation. However, issuing equity shares dilutes existing ownership as each share represents a piece of the company's control. Preference shares offer a balance between risk and steady income, appealing to more conservative investors. Preference shareholders receive fixed dividends and have priority over equity shareholders in case of liquidation, adding a layer of security. However, preference shares usually offer limited growth potential compared to equity. Moving on, bonds and debentures represent debt financing options where companies borrow funds and promise to repay the principal with interest at maturity. This type of financing is less risky for investors as it provides fixed, predictable returns. For the issuing company, however, it creates a repayment obligation, so cash flow management is critical. Deposits are a secure choice for businesses or individuals seeking guaranteed returns. Funds are placed with banks or financial institutions for a predetermined period at a fixed interest rate, ensuring principal safety. However, FDs have limited liquidity as the amount is locked in until maturity. Finally, lease financing enables companies to access assets like equipment or machinery without the upfront cost of purchasing them. Leasing reduces initial capital requirements and provides flexibility, especially for businesses needing assets temporarily or limited budgets. So each of these financial sources provide businesses with tools to achieve growth, stability, or flexibility. Selecting the right combination of these financing options aligned with business goals can be pivotal to achieving long term success in today's competitive environment. Finally, let's wrap up with a summary of what we have covered today and some concluding thoughts. We have explored various sources and forms of finance today. Now let's tie everything together and discuss the broader implication of these financial choices for businesses in India. In conclusion, choosing the right sources of finance is a foundational decision for any business, shaping its growth potential, resilience, and financial health. Let's revisit what we have discussed. The sources and forms of finance we discussed today, equity shares, preference shares, bonds, and lease financing, are critical for businesses aiming to secure capital for operations, growth, and innovation. Each financing option comes with its unique set of advantages and disadvantages that must be carefully weighed against the company's financial strategy and goals. I would be happy to answer any questions you have. Understanding the different sources and forms of finance, as we have covered today, equips businesses with the knowledge of to make informed and strategic choices. This approach helps them to not only survive but thrive, contributing to the larger Indian economy, whether you are a small startup looking to innovate or a large corporation aiming for international expansion. Selecting the right financial mix is a key strategy. This quiz is designed to evaluate your understanding of different sources and forms of finance. It contains 10 multiple choice questions, each with 4 options. Please take a moment to review each question carefully and select the most accurate answer. Business finance is more than a method for raising funds, it's a strategic tool for driving growth, managing risk, and achieving sustainable growth. A thorough understanding of these financial instruments, enables businesses to make well informed decisions that align with their operational goals and long term vision. Thank you for your time and attention.